Good afternoon and welcome to Position Sizing, my take on the markets. It's October 3rd, 2010, and before we begin, I caution you to invest at your own risk. I don't share in your profits, and so I don't share in your losses. Today I want to focus on the New York Stock Exchange advanced decline line. The advanced decline line is a market breadth indicator based on net advances, which is the number of advancing stocks less the number of declining stocks. As you can see from this chart, net advances fluctuates wildly from day to day and is very noisy. There are a couple of ways to smooth it out. First, you can apply a moving average. Here's a chart showing a 10-day exponential moving average of net advances. You can see that it's much easier to study patterns on this chart versus the chart that we showed of daily net advances. Second, you can study the advanced decline line on a cumulative basis over time, which we have showed here in this chart. Terry Laundrie at T-Theory Observations uses the advanced decline line in a cumulative form to project his long-term time symmetries. Now let's talk about momentum oscillators based on advances and declines. Sherman McClellan created the McClellan oscillator in the summer of 1969. The McClellan oscillator measures momentum based on advances and declines, and this is a chart showing the McClellan oscillator. To derive the oscillator, you subtract the 39-day exponential moving average of net advances from the 19-day exponential moving average of net advances. While the McClellan oscillator has been a staple of technical analysis for 40 years, I prefer to use my own homemade advanced decline momentum oscillator. In addition to market breadth, I wanted to incorporate market sentiment. So I divided the 10-day average of net advances by the 10-day average of the Chicago Board of Options Exchange total put-call ratio. The total put-call ratio measures put and call trading volume on all equities and the indexes. The ratio rises as market sentiment turns bearish and more puts are bought compared to calls, and the ratio falls as market sentiment turns bullish and more calls are bought compared to puts. Using the put-call ratio as a divisor sharpens the focus of momentum. For example, assume two net advances of equal value. The advance with the greatest bullish sentiment, in other words, the biggest fall in the put-call ratio, will make a higher momentum peak than the other advance. As such, my homemade oscillator is an excellent measure of momentum. Turns out my oscillator is very similar to the McClellan oscillator, as you can see from this chart. The McClellan Okay, that's better. You can see from this chart the McClellan oscillator is on top and my oscillator is on the bottom. The differences between the two oscillators are very small in this chart, but my research has shown that by incorporating sentiment, the homemade oscillator gives better divergence signals than the McClellan oscillator. That's it for today. Next time we'll discuss how to forecast cycles based on my homemade oscillator. Until then, happy trading.